Hi everyone, this is a technical analysis on your USD. Let's start with some fundamental background first. In the US, the Fed left interest rates unchanged as expected, with basically no change to the statement. Fed Chair Powell stressed once again that they are proceeding carefully, as the full effects of policy tightening have yet to be felt. The recent US core PCE came in line with expectations. The labor market is starting to show some weakness, as continuing claims are now rising at a fast pace, and the NFP data last Friday missed across the board. The US consumer confidence fell for the third consecutive month, although the data beat expectations. The US ISM manufacturing PMI last week missed expectations by a big margin, followed later on Friday with a disappointing ISM services PMI, although the index remained in expansion. The market doesn't expect the Fed to hike anymore. In Europe, the ECB left the interest rates unchanged as expected as the central bank has ended its tightening cycle. President Lagarde highlighted the weakness in the Eurozone economy and reaffirmed that rates will make a substantial contribution to curbing inflation. The Eurozone CPI missed expectations on the headline figures, but the core measure remained unchanged. This won't change the ECB's stance anyway. The labor market remains very tight, but the unemployment rate last week ticked higher. The recent Eurozone PMIs missed across the board as the economy continues to struggle. The market doesn't expect the ECB to hike anymore. Now, the daily chart, we can see that the USD pair bottomed around the 105 support and extended the rally last Friday, following the miss in the NFP data. The price is now rejecting the resistance around the 10760 level, where we have also the 38.2% Fibonacci retracement level for confluence. We can also notice that the price got a bit overstretched, as depicted by the distance from the blue 8 moving average here. In such instances, we can generally see a pullback or some consolidation before a continuation. On the 4-hour chart, we can see that from a risk management perspective, the buyers would be better off waiting for a pullback into the recent swing level here, around the 10670, where they will find the confluence with the red 21 moving average and the 38.2% Fibonacci retracement level. The sellers, on the other hand, will want to see the price breaking lower to increase the bearish bets and position for a drop back to the lows. On the 1-hour chart, we can see that the price recently broke below this upward trend line, suggesting that the near-term momentum is skewed to the downside. The sellers piled in to target the support around the 10670 level, while the buyers are likely waiting to step in at the support zone with an even better risk-to-reward setup. A break below this support would invalidate the bullish setup and give sellers back control. This week is pretty empty on the data front, with just the US jobless claims on Thursday and the University of Michigan consumer sentiment on Friday. The market is likely to focus on the US jobless claims on Thursday, given the recent weakness in the labor market data.